Live from WBFF TV, this is Fox 45 Good Day Baltimore.
Grow your money and avoid common investing risks. Brad Glickman from the Bernard R. Wolfe Associates is joining us this morning with more. Good morning. Thank you so much for coming in.
Thanks for having me.
So there are ways we can invest our money, and you were telling me it's not my fantasy football league. There are more prosperous ways to do so.
Yes. Well, let me start by saying there are three elements to any one investment. There's risk, return, and liquidity. Liquidity is how quickly you can convert an asset into cash. Now, you cannot have all three of those elements working for you in any one investment. You could have two out of the three, but you can't have all three.
Why?
For instance, if you look at your cash accounts, they're liquid, they're very low risk, but they're not earning much today.
Okay.
Your stock accounts, they're liquid, they can provide high returns as we've seen. The markets have hit new highs, but people forget stocks carry a lot of risk.
Right. Is that a risk we should be taking?
Well, it really depends. Is it long-term money? Is it short-term money? I don't claim to know where the markets are headed in the short term. I don't think anyone can really predict that. I'm much more comfortable holding the more risky investments in long-term buckets, such as 401ks and IRAs. So you may want to, when you're looking at your cash flow and your expenses, you want to have that emergency fund, you want to have that cushion, but also take a look at your short and intermediate term expenditures, because that money, if it's invested in stocks today, with the stocks at an all-time high as of this morning, you may want to think about it getting a little more conservative.
I think sometimes when people hear about investing, that means that they can't be spending their money right now, that they have to take it and put it towards something else. And so you almost in your mind say, I'll do that next year. I'll do that next year. You can't keep putting it off.
You have to be disciplined. You have to start early. There are a lot of studies that have been done. If you start in your 20s and you save inside your 401k and you invest systematically, it may not look great in the first few years, but as you continue putting money away, socking money away, it really grows and you build up a nice nest egg.
And that's safe. That money's not going anywhere.
Oh, well, hopefully. If you pull money out of your retirement plans prior to 59.5, there could be penalties associated with it. But as long as you stay disciplined and you dollar cost average, you'll do pretty well over a long period of time.
Brad, is there anything else quickly that maybe you've noticed we're doing wrong?
Well, a lot of people time the market, and that's always a recipe for disaster. The average investor gets it wrong more often than they get it right.
Yeah, that's no fun.
Well, that's because they're making their investment decisions based on emotions.
Yeah.
And because of that, they're buying high and they're selling low.
You got to stay strong.
You have to stay strong. You have to stay disciplined.
All right. Great advice. Brad, thank you so much for coming in.
Thank you.
And if you guys want more information, please log on to foxbaltimore.com/money. Good luck.